This is Jess Boy with an ExxonMobil financial analysis. Looking at the history of ExxonMobil, we can see that there isn't a huge fluctuation from year to year except for the spike we see in revenue from 2010 to 2011. After research, the spike was attributed to rising oil prices. Additionally, analyst Jason Gamble stated that the surprise in spike revenue came from more cost control, higher production volumes, and chemical margins. Comparing the years from 2010 to 2014, we can see that there is a consistency in the relationship of sales and revenue and expenses. Thus, we can see that Exxon is balancing their expenses with their revenue. Looking at the gross profit margin, we can determine how much from each dollar of Exxon's revenue is available to cover the expenses and overhead. While Exxon's gross profit margin has slowly dropped from 2010 to 2014, they are still doing moderately well. It would be in their best interest, though, to find a way to more effectively use their resources. Looking at the after-tax profit margin, we can see that Exxon has a fairly steady track record when it comes to converting sales into profits. They have consistently earned 8 to 10% of sales. This is much better than their competitor BP, whose after-tax profit margin ranges anywhere from -1% to 6%. Looking at these calculations and with knowledge of their cost-saving techniques, it would be safe to say that ExxonMobil is doing fairly well at turning a profit and doing much better than some of their competition. As we can see, the earnings per share only had to be adjusted for 2010 and 2011. We can infer that there were no additional convertible bonds or securities for the other years. Using this data, we can infer a lot of information about ExxonMobil's investing strategies using the dividend payout ratio. Looking at the above information, we can see that Exxon has retained a greater amount of profit in 2011 and 2012 in order to reinvest the money back into the company. Although they paid out a higher percentage in the following years, this information coupled with the following data of their investing activities, we can determine that Exxon is retaining a substantial portion of dividends and reinvesting them into capital. Here we have an overview of the balance sheet of ExxonMobil. We have pulled important information to help us look at how Exxon finances its assets. In order to get a comprehensive look at how Exxon finances its assets, we are going to look at the long-term debt-to-equity ratio, and we have found long-term liabilities of ExxonMobil only represent a range of 3 to 8% of stockholders' equity base. This is relatively low and means that stockholders have more money invested into Exxon than its creditors do. This is a good thing because it means that Exxon is not incurring outrageous debts that they need to finance through creditors. This theory is supported by also looking at the total debt to total asset ratio. We can see that very little of ExxonMobil's debt is funded by its creditors. With evidence from the dividend payout ratio, the long-term debt to equity ratio, and the total debt to total asset ratio, it is clear that Exxon is using its stockholders' money to reinvest within the company. Overall, looking at ExxonMobil's financials from 2010 to 2014, it can be said that they are not in bad shape. Their sales and revenue is slowly decreasing, but it seems from their cash flow and balance sheets that they are taking some previous profits from 2011 and 2012 and reinvesting them back into the company. It seems as though ExxonMobil is at a point where they are looking at a growth stage and potentially an expansion stage. It appears they are currently setting up a framework in which they can expand into. Whether this investment will pay off is hard to forecast, as a lot of their revenue is dependent on oil prices.